Hello, good morning, and welcome to the first webinar in a series that we're going to be doing here at Skybound Wealth Management. My name's Callum Murphy. I'm a senior financial advisor here at Skybound, and I'm the head of our Saudi Arabia desk in London. I'm joined today by Campbell.
Hi there, I'm Campbell Warnock. I work very closely with Callum on the Saudi Arabia desk here at Skybound. My sort of role is helping expats of numerous different nationalities sort of navigate the complexities of financial advice in Saudi Arabia.
Yeah, as Campbell says, we do work with a number of different nationalities, different profiles, clients who fit into all different types of financial advice they might need from us. We're not going to try and cover all of that today or tackle each of those complexities that you might want us to over the series in one webinar. What we're going to focus on today really is the basics. Some of the common challenges that clients bring up when we first speak to them when they've moved to Saudi Arabia, some of the difficulties and sort of pros and cons of the region, but also focusing on really some of the probably quite simple savings advice and budgeting advice that we would give to people who are new to the kingdom. So what we do really is cross-border financial planning. All right, so that's focusing on not only what you as a client are going to need today in Saudi Arabia and how you might make use of your finances during the period you're working in the kingdom, but also looking at actually how is that going to impact your later life? What's that going to look like when you move back to the UK or Australia, South Africa, Europe, wherever you might have moved to Saudi Arabia from? We actually had boots on the ground. We had advisors in Saudi Arabia as a company probably 15 years or so ago. That came to probably a lesser extent as people moved out and into Dubai, sort of following that transition where we saw a massive influx of expats moving to Dubai as it developed. But now we're back in a position where Saudi Arabia really is leading the way, offering some of the best job opportunities, offering some of the highest salary packages, obviously tax-free income and leaving people in a position where they're earning and saving very well. But it's an area where there's a lack of domestic advice. I think we can quite easily say that we speak to most of our clients and they don't have advisors already. Correct.
And I think a really important point to add on that, if you can compare the financial position of, the countries that the expats are coming from, so the UK, Australia, Europe, it's so different. You've got tax on income, tax on investments. The difference in salaries is quite significant. So if clients aren't taking on professional advice, what it tends to do is leaves them in a position where they've got a massive surplus salary, or they've got a lot of savings and you don't really know what to do with it. Okay, they're either doing nothing with it, or if clients are wanting to utilise it, they're maybe not doing it in the most efficient way possible. So that's where we come in and offer some advice.
So I think the pros in Saudi Arabia massively outweigh the cons, right? There's a number of things that when clients are moving over, I think before we have a conversation with them, just from speaking to other people who work in the kingdom and from speaking to employers when they're looking to move, they know about a lot of these things, right? We're talking about the career opportunities first and foremost. We're seeing people moving from probably moderately paid and sort of moderate level roles in the United Kingdom over to Saudi Arabia, where they're now taking on huge development projects. Right? Generally, that's for construction industry, for leisure industry, for tourism that Saudi Arabia is putting a huge amount of money into. You've then got the tax-free income element, right? The fact that you're not having to pay, for most of our clients moving over, it would have been 40% in the UK income tax. Not having to pay that is a significant advantage. The employee benefits, right, over and above the tax-free income, people have generally got housing in some cases. They've got flight allowances back to their home country. So that's usually for employee spouse and dependents, right? Getting 2, 3, 4 flights back a year. There are death in service packages. There are insurance policies in place. So there are a lot of things that you do get naturally when you're moving to the kingdom that you don't need help with. Obviously, that's on top of the fact that generally the weather's much better than the UK. You've got sporting events on your doorstep. You can turn up to pretty much all of the top sporting events in any category of sport you like will be in Saudi Arabia at some point over the next couple of years, right?
Yeah, I think that's a very fair point, Callum, that the pros certainly outweigh the cons, but there is some cons to moving out to Saudi. I think what's fair across the board is that expats are expected to work hard for the money. We're not suggesting for a minute that they're arriving in Riyadh earning £20,000 a month and not having to work for that. All right. I actually find it very difficult trying to find slots to sit down with my clients that they're often so busy. And I think another thing that people maybe don't appreciate when they first move over to Saudi is actually how expensive the first sort of 6 months to a year is. Okay, for clients who are not lucky enough to have their housing covered for them, often you have to pay your rent 6 months up front, sometimes a year up front. You have the costs of furnishing an apartment, buying a car, getting set up really before you've started to see the fruits of your higher surplus. And then I think another thing that I really do sympathise with a lot of my clients is often their family is back home. Okay, so you've got the emotional ties of that, but also financially, because they're often having to run 2 households. Often it can be very difficult for my clients, Callum, to send money back home. So what they need help with is accessing international bank accounts, international currency accounts to help send that money home, and it can vary from very small amounts to quite significant sums of capital. Okay, what they're often not aware of is the different financial structures available to them in the kingdom.
When you say financial structures, you mean then things other than their normal bank accounts that they'd be set up with when they move over and the savings account they might have with those?
Yeah, exactly. We're talking about investment vehicles here.
Okay. And back home then, clients generally need very little help, right? So in the UK, most of our clients are aware of their options. They generally don't need an awful lot of help throughout their working life unless they fall into that high net worth category or they get to the point where they're legacy or succession planning, right? You've generally got your employer contributing to your pension, right? In some cases, people have got non-contributory, so it's just their employer contributing 10, 15, 20%. But in most cases, you've also then got auto-enrollment for yourself to be contributing to that pension. You've got auto-enrollment to your state pension in the UK. And most are then aware that if they go over and above this, they've got access to things like their ISAs, where they can be saving, investing tax-free. And most people really are quite confident that if they make use of their employer pension, their state pension, their ISA allowances throughout their working life, it's usually enough to provide for their retirement provisions, right?
Yeah, definitely. In Saudi, it's not quite the same. Generally speaking, there is a lack of corporate retirement provisions. Okay, pensions don't exist in the same way or format as they would back in sort of the UK, Australia, or elsewhere in Europe. What does exist is some form of gratuity or of end of service benefit. Okay, but it's not enforced, and it varies company to company, and it usually depends on length of service and things like that. So yes, very different for clients moving out there for the first time.
Okay, so just then to summarise really for those who have recently moved out to Saudi Arabia, generally speaking, when you get to the kingdom, there aren't any domestic investment vehicles or retirement provisions outside of your company potentially having their own scheme. There aren't going to be specific investment vehicles in Saudi that are designed for expats to then make use of when they inevitably retire somewhere else, right? people should be aware that they're going to lose access to their domestic facilities back in the UK or in Australia or wherever it is they're moving to. If they had tax allowances like ISAs and UK pensions, you're generally not going to benefit from using those anymore once they get to Saudi Arabia. Most of them will have been given advice on moving to Saudi and where they might be able to put their money from a cash perspective. But it's really, for most of our clients, the difficulty is understanding what then to do with that cash, right? Rather than saving it in a local bank. And there are some complexities to investing and holding capital in Saudi Arabia, should they choose to go that route, right? You've obviously got Sharia law that they need to be aware of. It's not necessarily a problem, but again, it can create some difficulties if you're not aware of it and how that might impact your assets upon death, or in the way that that money would need to be invested during the time that you're alive and it is invested. We've obviously then got some currency issues, right? And not as bad as what a lot of my clients will have faced when I've worked in some more remote parts of the world across different countries in Africa where they've got very niche currencies that are difficult to buy and sell. Obviously, the Saudi riyal is pegged to the dollar, which is probably both its biggest pro and con, right? It means that it is tied to, from a value perspective, a long-term stable currency, but it also means even if Saudi Arabia is in a very stable and good financial position, things like we're seeing at the moment with a little bit of volatility in the United States means that their real valuation is going to fluctuate as a result of that. And I think for most of my clients, and I assume the same for you, most of my clients aren't going to want dollars in their retirement, right? It's generally going to be GBP, euros, or Australian dollar. So I think you and I meet with very similar clients, right? We both quite regularly meet British clients or Australian clients, or in some cases European clients who have recently moved to the kingdom, right? I think the majority of people that we onboard as clients that join us are relatively new to Saudi Arabia. That's generally when they seek financial advice. And we probably see some clients in quite similar positions quite frequently, right? So I think a good example would be a British family or a British worker who's moving over probably midway through their career, maybe early to mid 40s, young family back home in the UK, and get here to Saudi Arabia and they've pretty much got to reset their budgeting habits, right? Now in the position that, particularly if they haven't got employer-based accommodation, they've now got to pay rental on the property they got here in the UK, but also got a young family back home to support. And really, you've got to treat it as a complete reset and look at actually where should you now be focusing your income? How much should you be allocating to different stages of savings, retirement planning, and so on? And what does that look like now that you're in a completely new region with completely new financial systems? Well, for me, I generally split it into 4 stages for most of my clients, and I use these same 4 stages with anyone regardless of where they are in the world, right? The differences are, in some parts of the world, parts of it are done for you. In places like Saudi Arabia, generally you're covering all 4 sections. So that for me would be your essential living costs. It would be your retirement planning, or retirement savings. It would then be your emergency savings, that cash buffer that you'd want to be putting some money into, and then your discretionary spending. Right, so that's ultimately your fun money, things that you want to spend money on but don't necessarily need to, and that's usually the one that should be adjusted or might shrink on more expensive months when things are different.
Yeah, I use exactly the same 4 categories as you, Callum. It's a pretty universal budgeting model that gives you a really good idea of where your money should be going, particularly now in Saudi Arabia when the retirement planning is in your hands.
So that model is quite commonly known as the 50-15-5 rule, right? It's a little bit of a mouthful, but really there what we're talking about is 50% into your essential spending, 15% into your retirement savings, and 5% into your emergency fund. So that leaves you with 30% as your discretionary spending, right? Some of your clients who have logged in today will probably have already heard you explain this to them in some detail, but can you just talk to us a little bit about how you would explain the 50% essential spending to someone who's just moved over to Saudi and what that should include?
Yeah, of course. So when you look at that, 50% of your income, okay, should be dedicated to covering your essential living costs, all right? This includes your rent, utilities, groceries, transport, anything you really need to sustain your day-to-day life, okay? This is the pot that's likely going to change most for clients that move over to Saudi. The lucky ones who are in sort of company paid accommodation will find their living costs go down, while others who are having to pay for maybe a mortgage back home in the UK for their family, plus their rent in Saudi Arabia, so it can be quite expensive. Your travel costs are also included in this, which will likely go up now you've moved over. You'll be flying home to see family, you'll be flying to other parts of the GCC, going on holidays and things like that. And really the other aspect that expats really must consider in that essential living cost is your insurance costs. Okay, that has to be included as well.
So the 15% then of this 50-15-5 rule would be the retirement savings portion, right? And this is probably the one that we see neglected most commonly when people move over, right? Because of what you've just explained about their essential living costs changing. So I'm sure for most of you who are logged in with us today, you'll have experienced those changes in your essential living costs. It's usually the saving for retirement that gets put on the back burner for the first 6 months, 9 months, 12 months, whilst people almost get their feet under the table in Saudi Arabia. So really this section here, this 15%, we're talking about any contributions that you're making towards your longer term financial planning, right? So it could be specific pensions vehicles or retirement facilities, but it could also be savings accounts, other investment vehicles that the intention of is to hold up until retirement or until you draw passive income, right? So when people move over from sort of mid to senior roles in the UK and they move to the Kingdom, they're generally going to be leaving behind things like non-contributory pension schemes or even employer-matched pension schemes of maybe 10% from the employer, 10% from the employee. That's ultimately a significant portion of your income that you were previously saving towards retirement that often, when you move to Saudi Arabia and it's no longer mandated, people stop budgeting for, right? But it is always advised that overall, you're allocating 15% towards it.
Yeah, and I think it's a good point to note is that actually as an expat you have the opportunity to access retirement vehicles, okay, and retirement provisions in places with far more favourable regulation when it comes to the security of those assets and the tax efficiency of those assets. So when I say that, I'm talking about places like the Isle of Man, Guernsey, Jersey, Luxembourg, Mauritius, okay, and these policies are designed specifically for expats, okay, so that there's far more flexibility when it comes to accessing what age you can access that capital and where you can draw down that capital from.
Yeah, okay. And it's probably worth noting for clients who do have access then to things like an employer matched savings scheme or an agreement for a gratuity payment depending on their length of service, they should factor that in. Right, when working out this 15%, we're not saying it needs to be 15% of your net salary if you've also got a significant gratuity, right?
Correct. Then the third section, Callum, would be putting 5% away for your emergencies. Okay, so setting aside 5% of your income for an emergency fund helps you prepare for any unexpected expenses that come up. So things like medical emergencies, car damage, or even as severe as losing your job. Okay, what this should do is act as a sort of financial safety net to give you a little bit of peace of mind. Okay, of course, some of these emergency expenses can be offset with insurances, all right, but what I always recommend to clients is holding a pot big enough to cover 6 months of expenditure, so that should anything happen, you can sustain yourself for that period. Any other bigger emergencies, so things like house damage, or you would expect that to be covered in the insurance.
Okay, and that really leaves us with that final 30%, right? The balance, which is your discretionary spending. So that's everything that we don't really need to cover on this call. We don't really need to put a specific budget in place for. It's whatever there's left over, you can spend on what you like, right? If you're sticking to the first three, and you're putting that money away for your longer term retirement planning, and you're building up your cash pot for your emergencies, you should be able to enjoy the additional 30% you got left over, right?
Correct. Enjoy that flexibility.
So let's take a look then at how someone can maximise their retirement pot by starting sooner rather than later, right? Using some fictional case studies, all right? Let's start by comparing how a 35-year-old planning for their retirement would differ from someone who's left it until they're 45.
Okay, let me have a little look at the numbers and see what that looks like. Okay, so you have client A, the 35-year-old expat, and he chooses to invest £1,500 a month over the next 25 years until his retirement age at 60. Okay, that client would have contributed a total of £450,000. All right. As a financial advisor, right, I'm never going to suggest that he builds that capital in a cash account, gaining little to no interest, all right? But without maybe going into too much detail about the different investment options he has, but let's assume that he takes use of something that allows him to take advantage of tax-free gross roll-up, all right, or compound growth, as it's more commonly known, all right? And if he was to achieve, 8% return per annum on that capital, the pot value at the end of the 25 years would be just shy of 1.5 million. Okay, now that would give most people a pretty comfortable life in retirement. Okay? I think probably the most important point to take from that, though, it's nearly triple the value of what the clients contributed. Okay, that's the power and the beauty of compound growth, especially over a 25-year window. All right. Now let's maybe have a little look at that, what that looks like for someone at the age of 45. Okay, so only having 15 years.
Yeah, so I've ran those numbers, right, and we're talking about a very extreme example here. Right, we're talking about someone who's moved to Saudi at 35, but ultimately had discretionary spending of 45% for the first 10 years and not saved anything towards their retirement. It's unlikely you'd ever see it happen, but to show the difference in the impact that would have, that's what we've ran the numbers on today. Okay, so looking at these numbers then, a 45-year-old expat we're now starting at, okay, or client B here, has decided they're going to start saving exactly the same amount, so £1,500 a month, but they've now only got 15 years away to retire at that same age. All right, so two problems with this. One is that they've only got 180 paychecks to make their contributions, right? So there's going to be far less capital going in. And two is that they've only got 15 years of compound growth, not 25, right? So assuming that this client gets access to exactly the same investment vehicle, they get access to exactly the same fictional 8% return that we spoke about throughout that investment term, they will have contributed 270,000 GBP over the 15 years, and the pot value at 60 would be just shy of 520,000 compared to the 1.5 million we spoke about if it was done over that additional 10-year time frame. So you can see really that by investing for that shorter period of 15 years rather than 25 and reducing the power of compound growth on that money you've put in, ultimately it means that the value come the end is going to be significantly lower, right? We've obviously used linear calculations here in assuming 8% every year, which is never going to happen on either of these, regardless of what age you start saving. But it's just so that we can actually see the difference between the two. And ultimately it should allow you, particularly those of you who are joining who maybe aren't at 45, 50 yet, to consider what impact it will have if you wait as long as that before you start allocating your 10, 15, 20% towards your retirement savings. I think one other point I will just add that we haven't really covered here is that in reality, the later you start investing, the later you start saving for retirement, the lower risk your investments are generally going to need to be. Right? Because you've got that shorter investment horizon, you usually can't allow for quite as much volatility for quite as long. So you might only have the first 5 years of that 15-year period that you've actually got higher risk investments in there, whereas the 35-year-old could probably have had 15 years where they've had higher risk investments and they've only needed to start reducing the volatility at a much later stage.
In conclusion, it's essential that you have a budget in place as an expat in Saudi Arabia. Understanding, your living costs, understanding your expenses, understanding now how much you need to be putting away for retirement, and understanding how big your emergency pot needs to be will go a long way in giving you the financial security and the financial peace of mind that you need.
So thanks again everyone for tuning in today. Appreciate we've covered a few topics within that, but really it's going to be potentially more relevant to some than others. Understand today the idea being to start with the basics of the first things people need to look at when they move to Saudi Arabia. The idea being that actually, as we continue with this series of webinars, we'll focus on some more specific areas to particular nationalities or family situations that might need covering for you. What we will ask is if you have any feedback or any specific areas of financial planning that you want us to discuss, do let us know. We'd welcome the feedback, and those are things that Campbell and I will then aim to include within the next webinars that we complete. For those of you who are maybe a stage ahead of this and maybe you're ready to start looking at this on a more personalized level and which specific investment vehicles you might need, be it for the retirement planning or for building that emergency pot, feel free to reach out and both myself or Campbell would be more than happy to schedule an initial introduction with you.